All right. Good afternoon. Welcome back here to Trader Minute. Great to have you aboard. When we were doing the work for the challenge to determine what time to make the trades, right? The morning time was pretty easy. It was just testing a few different time intervals. The afternoon time period was a little more difficult, and this kind of 2:30 time period was the best. It was the best, but it had a drawback. And that is that when there are Fed days, it can lead to a lot of chaos, meaning if we go into the Fed decision with a whole bunch of trades and then, boom, they're getting knocked out on a little bit of a whipsaw, or if we don't have many trades and we get a ton of signals, there's a lot of different things that could happen. And through some of the testing, we went through a few Fed days, and a few of them were pretty chaotic. But the reality is they didn't change the trajectory of results when it came down to things. So we said, okay, we're going to stick to this 12:30. We'll handle it if and how and when it happens. And so today's one of those days. Now, we're not going into the Fed today with a lot on the table. We have a Boeing position here, which is 60% of yesterday's position. We basically, have that yesterday, and the rest is cash. CSX knocked us out this morning. There were no new signals here this morning to react to as well, so, nothing really to do. Now, with this Fed meeting, there are not a lot of, there's not a lot out there. We have Target with a 3.7 downside crossover. We have Vulcan Materials with a 3.7 downside. Neither of them triggering. We have Coke, which had a 3.7 downside yesterday and kind of has a little bit of upside on it today, but far from triggering. So no new triggers to adjust to. So not a lot of chaos. Not a lot of not a lot to do here with it. Now, we do have one position on the board, and that is Boeing. And Boeing kind of had a little bit of a sour day here today, down about 460 here right now. Let me get the option price here for us, 1175 to 11. We'll go with 1170 here, and we'll throw that in here to the price on it. So we're down about $200 on the position overall. Between Boeing and CSX today, kind of, not what we want to see. But, Boeing still far from its exit level of 263. About, $6 away there from that. And far from the profit level there. So nothing to adjust, here with Boeing. So this Fed statement, very easy, in terms of how to react and what to do here with it. Now, I know what's going on with the Fed, what's going to happen. I know the anxiety it creates. The market itself can have quite a few whipsaws. We can see, we see the media. It's all about opinion, right? What the Fed's going to do, predict what the Fed's going to do. But you have to predict what the Fed's going to do, which is kind of easy, right? Because the Fed's about as transparent as it comes. But predicting the reaction to the Fed isn't all that easy. And, so far we saw an initial downside reaction here. That got bought up fairly quickly by the algorithms and on some, decent volume, but this isn't great volume for the Fed. And, we've just kind of, just sat around this 29.25, 29.30 area here on the S&P. We do have Powell, who is starting to speak here right now. So we're still in the reaction phase. We're still going to see more reaction here to it. If you look at stocks like Bank of America, very sour reaction to the statement. right? You go, oh, this must be down. Market must be down after that statement. You look at Caterpillar, it's been a positive reaction to the statement, right? You look at something like CSX, which I mentioned, this morning. It could whipsaw us out and have us back in tomorrow. It's getting a pretty positive reaction here to the Fed. We are seeing a differentiation when it comes to the reactions out there, so far. And nothing that I look at and go, wow, this is game-changing for the market itself. The SPY sitting here at about 7 points up. And let's face it, if a week from now you were to look at the market and you come back and look at today, are you going to go and say, well, that was a game-changing type of day? No, not at all. Not at all, right? And as it sits so far, and again, we have live catalysts going on right now that could change things. But as things are so far, there's nothing game-changing about things here today in the market and within most sectors. And things are kind of like what we talked about yesterday, and the market vibe itself is remains bullish, and we're just getting some differentiation based on some of the reaction. You do see the U.S. dollar slipping. And slipping sharply here. This is one area, of change. And let me pull up the euro versus the U.S. dollar. You can see this started to change overnight, so not all that dollar loss is here off the Fed. But we have seen the euro push higher here on the Fed. Which has pushed the U.S. dollar down. That should translate, typically that will translate into a move higher on gold, and we've seen a little bit of bounce higher here in gold. And when it comes to gold and the GLD, we've seen kind of a lot of chop here in it, but it is, migrating, continues to kind of migrate higher through all that chop. And let's face it, if we see the dollar continue to go down, we're going to see gold, trade up in the 135, 140 area on the GLD, and it may not take long to get there. But my stance on gold in terms of the long term, my bullishness on gold overall. Okay, I'm kind of watching some of the comments come in, from the Fed here or from Powell as I'm talking. So I kind of have to corner my eye on that, and nothing too major here, so far. I think the Fed has given the markets what the markets expected. We looked and we showed this Fed Watch tool earlier this week and just showed how the market was not pricing in a rate cut here today. It was about 25% when we looked at it. Yesterday it dropped to a 21% chance of a rate cut. Now 5.8% chance it'll go to zero here. But the rate cut is being priced into next month, and next month in a big way. If we look at a day ago yesterday, it was 68% chance that the market had priced in for a rate cut. Now it's an 85% chance for a rate cut that the market is pricing in, and basically zero price in of the rate staying where it is. So the market's actually pricing in a greater chance of getting a half point reduction in the rate next month than it is for the rate staying the same here. So we are seeing, the market expectation shifting here. We can also see it out a little bit further if we come into September. And we look at yesterday, 33% chance. By September, the market has a 66% chance that there's going to be 2 rate cuts, that there's going to be a 0.5 rate cut here. So that's what the market is pricing in. We have seen the Fed very carefully target the market, be very clear about what it intends to do. And we have seen the market historically react to the cut or the hike before the Fed actually cuts or hikes. And when it comes to the rate decision day, it's the market adjusting for the next month, not basing decisions on what is happening right here and right now. So anyway, that's where we're seeing the shift. We are seeing the shift in the market mindset of rate cut, which is one of the things that's pushing the banks lower, right? There's always worry when you cut rates. Is that positive for the banks? And well, some analysts say yeah. Some analysts say yeah, that if you lower the front end of the curve, it'll be positive for the banks. I don't think that's a great argument for the banks right now. I think the best argument for the banks is, hey, if the Fed cuts rates, that's going to stimulate the economy. Growing economy equals better banks. I think that's the best bullish bank argument out there, right now. But if Fed rate cuts don't do anything, the Fed's in a pretty dangerous position. They're in a dangerous position. But I want to show, something here when it comes to rates and how they set. So we're going to go to the U.S. Treasury. Right, U.S. Treasury rates. And we're going to come in and take a look at what the interest rates are for various months. Okay? And if you look, we have a 30-year is going for $2.55. Now, this was updated at the close of the market yesterday. But the 30-year rate's $2.55. That's historically pretty low. The 1-month rate is $2.18. Now, the 3-year is $1.80. It's actually, you get paid less to hold something for 3 years than you do for a month. Doesn't make a lot of sense to most, and but when it comes to what has been the norm in this market, this is what we've had. We've had a curve that's kind of inverted in the middle, and, on the ends is, not flat, but is pretty tight. Right, there's not a big spread between the 1 month and the 30-year. But look at the absolute values here. 218 on the 1 month, 255 on the 30-year. Keep those in mind, those absolute values. And now let's come into Market Watch, and let's come into rates, and let's come into Germany. And compare this to, the German market and what the German bonds look like here. And let's see here. I'm on the 10-year. I want to be on a little more broad. Let's see. Did they change it? Yeah, they've changed it a little bit here, so my apologies. Let's... Well, here we go. I'm just going to come in here instead of wasting some time. I'm going to come in here. But look at the percentage. This is the 10-year government bond, minus 0.286. Minus 0.286. Yeah, it's negative. In fact, you can see the yield curve down here below for Germany. You can see that rates are basically negative. Now, this is nothing new. They have the current and the year ago, but for the 3-month, it's negative. For the 6-month, negative. 1 year, it's negative. 5 year, it's negative. And you can see how the back end of the curve has cratered and collapsed. You compare that to the U.S. U.S. rates are significantly higher than German rates. And you think, well, okay, maybe that's just a German phenomena and, just something going on with Germany. Well, okay. Let's go to Japan. All right, different part of the globe, different economy. Here we go. Here's the yield curve. Here's the zero. Here are the rates. Anything below my blue line is below zero. Rates are negative. The 30-year rate, the 30-year rate right here, right? That's what, 0.3? What was the U.S. rate? 2.55? U.S. rates are almost 10 times the rates of some of the other major economies around the world. That's nothing new. That's nothing that's changed. But this argument that, hey, you know what, the Fed doesn't have any room to cut rates, doesn't hold a lot of water. The Fed could easily get themselves into a position here where they actually have to start taking rates negative. If a rate cut doesn't solve things for the economy, if a rate cut doesn't see some economic stimulus, the Fed may be forced, like Japan did, like Europe did, to push rates and push them into the negative territory. Now, that sounds kind of ridiculous, and 10 years ago, 20 years ago, it would be laughable. But we have now had many years of major economies running with negative rates. It's not that laughable anymore. There's some precedents. There's some, there's some situations that can be studied and analyzed. And for the Fed to ultimately go down the path of negative interest rates, even if we start to see a little bit of economic uptick, I think that's a very interesting risk that's out there in the market. And it's one that, let's face it, what we've seen out of Japan, what we've seen out of Europe, pretty much shows that, no, they don't have to normalize it. They absolutely don't have to normalize rates. They can keep them really low. They don't have to take them higher. Now, low rates that, benefits borrowers, hurts lenders, right? There's always, two sides to a coin. But, this argument here that, we've seen passed around the last couple of days that the Fed doesn't have much room to lower rates, they have a lot of room. They have a ton of room to lower rates, and just to bring rates in line with the global economy. So, that is something worth watching. It is something that we're going to be dealing with in the markets for the next 6 to 12 months at least, right? This isn't going away. This isn't, this is kind of like trade war stuff. It's not going away, right? There's not going to be a silver bullet one day and boom, okay, that's over, on to the next thing. This will be something that, markets are dealing with here for a very long time. So wanted to share that here about the Fed meeting and what we see happening and going on. You can see overall, we have a reaction high, maybe a reaction low. This isn't exactly a great reaction high, reaction low scenario. Volumes have really dried up already. Excuse me, that's gold. I'm sorry, that didn't look right. Let's pull it up here, and you'll notice the S&P looks similar to gold, right? And so you have the push up, you have the kind of a quasi reaction low. But, nothing too major here to base, hi, okay, you know what, if the market goes above this level, it's all clear for the bulls, or below this level, it's all clear for the bears. We haven't seen that put in here just yet. You'll notice the volumes. The volumes are not very heavy. We saw heavier volumes yesterday morning than what we're seeing right now. And what does that tell us? That just tells us major decisions are not being made yet. And one of the things that we have seen over time is that big fund managers, after the Fed, they tend not to start to make their decisions until the next morning and later on in the morning. And before that, it's just a lot of herky-jerky up and down, type of reaction like what we are seeing right now. Okay. All right, so challenge going to go into the close here today with Boeing, and it'd be nice to see Boeing rally a little bit into the close today and see it resume yesterday's rally here tomorrow. We'll look and we'll react to the next signals that potentially come in here on the watch list tomorrow morning. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.